Before putting any property on the market, understanding your tax implications is crucial. Here's why. If you've lived in a property for at least 2 of the 5 last years, there's a substantial capital gains tax exemption. A single individual can get up to $250,000 tax exemption, while a married couple can claim up to $500,000. Let me start with an example. My spouse and I bought a property for $500,000 and in a few years later sold it for a million. As a married couple, we benefited from the $500,000 gain, which aligned with our tax exemption, resulting in no tax liability. It's an unparalleled advantage not found in any other type of asset. However, anything above the $500,000 threshold might be subject to capital gains taxes, which varies by state and federally, of course. California's specifics and federal rates actually can reach up to 20%, and higher earners with an adjusted income, gross income exceeding $400,000 could face an additional 3.8% capital gains tax, which kind of encroaches on approximately 30% on any amounts above $500,000. So there's a way to blend tax laws using Internal Revenue Code 121 with the 1031 exchange to your advantage. If you've lived in your home for an extended period and moved out for 2 years before selling, you could actually leverage a 1031 exchange to avoid the tax on additional gains. It means zero capital gains tax, but by retaining the property until you pass, your heirs could receive the entirety of your wealth free from capital gains taxes. For investment properties held over a year, capital gains taxes definitely apply, but a 1031 exchange can defer these taxes. So the saying, swap until you drop, implies continual 1031 exchanges until death, granting your heirs a step up in cost basis without capital gains taxes. It's a tried and true method of building generational wealth and requires a lot of planning. Let me know how I can help. My contact info is below.